Today I want to show you guys something your money guy doesn't want you to see. Right now is a great time to be an advisor and a great time to be an investor because the market has been killing it lately. Everybody's making money. If you aren't making money right now, one of two things is happening. One, you're not as good at picking stocks as you think you are, or two, you're working with somebody that's taking weird risks with your money. In either of one of those two cases, you should fire your financial guy right now. But right now, you're probably meeting with your guy and he's sitting down with you and he's showing you how great your returns are and you're like, holy crap, my guy is amazing. Like, look at these returns that he's getting for me. He's so sweet. But if that's all he's bringing to the table for you, all he's sitting and talking to you about is what you've gotten in the last year or 5 years, I want you to rethink the relationship because he's bringing nothing to the table. He's just showing you something you could read on your statement yourself. If he's not providing you with financial planning advice, then he's useless. He's not doing anything because all that guy has done is put you into the portfolio that his company has told him to put you in based on the answers you had on the questionnaire. So I want to show you something that every single person can check, and in today's case I'm just going to pick on RBC. It's not because I'm trying to pick on RBC, but everybody knows them, and this will be a good example for you to follow along with your own portfolio. Let's just pretend now you sat down with your guy and he said, look, you've been invested with me for 5 years, you're doing great, you put 10,000 in 5 years ago and you've made over 11% in the last 5 years and you've made over 14% this year. Like, holy crap, I'm the best. But is that actually good? And that's the question that I want to answer today. So what I want you to do is I want you to Google your own portfolio or your own funds and see what happens. So one of the top 3 page searches that comes up is going to be something called Morningstar. And Morningstar is going to open a page, and the first thing I want you to look at on the top line is here where it says the MER. So today we're looking at the RBC Select Growth Portfolio, which has an MER of 2.04%. That means they're taking off 2.04% every year off your return. You don't see it. Now keep in mind that when you work with me and you invest your money with Wealthsimple, your portfolio is going to charge you a total MER of 1.15%. So I'm always going to be lower than what you're going to pull up on this page. Now you want to scroll down to the chart and it's going to have 3 lines on it. So in this case I've set it to 5 years and let's look at what happened. Now you'll see 3 lines. There's going to be an orange line which is going to be the group average of those funds in that ballpark. They have the same aggressive nature. They're trying to achieve the same things. Then you have the blue line, which is going to be your fund. So in this case, you can see the blue line is a little bit above the orange line. The RBC growth portfolio has done a little bit better than average over the last 5 years. And then you're going to see a green line. And that's basically how I'm telling you to invest. That is the index that these funds are trying to track. Now you can see the green line, there's a big space there. That's what the index has done. So in the last 5 years, if you invested 10 grand into this index, you'd have over $19,000. RBC would be up to 16,760, and the average portfolio would be 16,444. Now, which one do you like? I'm also betting that almost every single person that checks into this is going to see that the green line is higher than their portfolio or their fund. Every once in a while, there will be funds that are beating the index, as I've told you before. Now we're going to scroll down one more time to the last sort of group of numbers, and this is, I just want you to focus on a few things here. So your guy said, well, you've done over 14% this year and over 11% for the last 5 years, but then right underneath that it shows you how much it lost to the index by. So in the last year, the index has done over 18%. The RBC fund has lost by 4.5% to it, and over the last 5 years it's lost by over 2%, which, as I've said 100 times before, is because of that MER at the top. So all I'm telling you is that you can increase your investment returns, or the probability that you're going to get in better investment returns, by reducing your fees and investing in the index. So I'm not telling you this is what's going to happen going forward, but I know that if you check, you are going to see that the green line is probably above your line, and that's all that I care about. And the rest of the stuff that I'm going to worry about is giving you proper financial planning advice. Thanks.